Hello everyone. Today we will discuss about the psychological bias which influences our investment decision making. As you know, today Nifty has crossed 20,000 mark. There is all round optimism, lot of positive momentum that's going on. So whether any kind of biases impact our decision making, that we will discuss today. Nifty gains since end of March till today is 15.2%. Mid cap index during this period has gone up by 38% and small cap has performed 44% over this period. If you look at forward PE for 1 year, the 18.5 times of forward PE we are getting on Nifty. The same was 17.5 during last 10 years. Around 31 lakh demat account has been opened in August 23, which was 29.7 lakh in July, and corresponding number in the same month of last year was 21 lakh. This means record number of demat accounts are opening, and there's so much of optimism. If you see the behavioral finance, it is actually the study of psychology of an investor, how it influences the investment decision making. It was started by the Daniel Kahneman, and Richard Thaler has been created for integrating the behavioral finance with the standard financial assumptions. So what is the difference between standard finance and behavioral finance? In standard finance, economic is at core, whereas in the behavioral finance, the psychology is at core. In standard finance, we take investors as a rational investor, and they process new information without any bias, whereas in the case of behavioral finance, they process all the new information with a preconceived notion, and they are generally biased on the investment angle. Efficient market hypothesis is there in the standard finance, which is not present here, and collective herd mentality decide the prices of the market and the momentum or the movement of the market. When the decision making is taken, it is a rule driven and some scientific or analytical angle is considered, whereas in the case of behavioral finance, if you see, it is very inconsistent and generally depends on the feelings or experience of the people. Risk return trade-off is the foundation of the investment in standard finance, where the same, if you see loss aversion or greed or some kind of overconfidence, bias, those generally takes over. So we'll discuss the biases in the upcoming slides. So the rational decision making, which is the norm of standard finance, is generally absent in behavioral finance, which are mostly based on ad hoc decision or thumb rule based. Bounded rationality, it is a situation where like investor take decision on limited information within a given short period of time, and their ability to comprehend the complex information is very less, so they somehow manage with a sufficient, or I will say the satisfactory and sufficient mix, which is called a satisficing region, which is like a part of satisfactory and part of sufficient information they process and take decisions. So they are not irrational, but they take decision under certain restrictions of rationality, where the informations are not fully processed. Prospect theory also says that the prospects are generally framed in the beginning and they are later on evaluated and chosen. So there also like a kind of mental block was already present when the decisions are taken. In this case, people are generally risk averse about gains. They realize it quite early and they lose out the rest of the gains. Whereas when it comes to the losses, they hold on to the losses and keep suffering them for long time. And monetary losses hurt them more than the pleasure of making gain. So still, like they continue with the losses in the hope of recovering that losses in coming period. Coming on the biases which influences our investment decision making. Biases, of course, are categorized into two parts: emotional biases and cognitive errors. Emotional biases are coming from the feelings or emotions or some personal experiences. So if we see, there are different types of emotional biases which we have listed down here. We'll cover one by one each of them. Sometimes not just one bias, it's a combination of multiple bias which impact anybody's decision making. So the first one bias is herd mentality bias. Means people do what others are doing. It's a social influence. When others are doing, they must be doing right. That's how people take their call. So they generally follow the crowd, they generally follow their colleagues or some other influences, and they keep on going investing on the stock without even proper analysis or proper understanding of them. We should have our clear investment philosophy, we should have our risk very clearly defined, understood, we should understand the investment and then only decide on the investment. Second is loss aversion bias. This is just to hold, this is an impact where which is called disposition effect, where people hold on to the losers for long time in the hope of covering up those losses and somehow to avoid that loss. Let's not book the loss, somehow somewhere we will get the price increase and we'll book that particular profit and at least avoid that loss. So they sell the winners very soon and they hold on to the losers. So suppose if 2 shares are purchased of 2 companies at 100 rupees each last year, one has become 70, other has become 130, they'll sell off the 130, okay chalo, let's get the 30 rupees benefit, whereas the 70 rupees stock which is showing poor performance, there is a further chance of going down, yet they will hold on to that, assuming it will sometime recover back to 100. So we should have a proper discipline and set trading rules, and we should have some kind of loss restrictions like stop loss arrangement or some benchmark below which if it goes we should exit those investments. Third is a confirmation bias, where investors generally have some preconceived notion and they just go and take those information or take the confirmation from their colleagues, friends and others just to confirm that they are right. If any contradictory information comes, they avoid it. So people should generally stop getting into this kind of confirmation bias by properly evaluating them, doing a reality check and keeping an open-mindedness. The other one is stereotyping or availability heuristic bias. It is actually people look for representative characteristic and they base their decision based on the general perception about those characteristics. Suppose a branded company or a good company is a good investment, that's what people think, but that may not be the case every time. Similarly, a high profile manager are generally considered to be a very good person on whom they can bet, whereas that particular person associated with a company may not be offering us a good investment. Similarly, if somebody has made a profit in IPO, they think IPOs are always good and they keep on investing in IPO without analyzing that. Those are called stereotyping or available heuristic bias. Familiarity bias. Sorry. These bias, generally people tend to prefer the familiar things over the novel or the better options. They generally concentrate and treat those particular stocks or securities which they are familiar with, either on account of its known product or known company through someone, or somebody is working on that in that particular company. So they keep on continuing with those familiarity, or my father is invested in that stock, so I will also invest, like that. And because of that familiarity, they lose on a lot of opportunity. So again, people should avoid that, keep an open-mindedness, do proper research and study before investing. Another one is overconfidence bias. In this particular bias, people think they have their superior analytical and cognitive abilities, and that's how they make more money than others. This is called overconfidence bias. These kind of people generally tend to concentrate their investment in few stocks, few sectors, and they miss a lot of good opportunities because they're overconfident on that. So people should do a reality check to avoid those kind of biases. Other one is optimism bias. When people are too much optimistic about something which is not going to happen, like suppose somebody think that I'm going to retire at 60 but at the age of say 56 or 57 I will start my retirement planning and build up the corpus. So that 3-4 years may not be sufficient to building that retirement corpus, but still it's a overconfidence or like optimism, highly positive thought which is unrealistic. People go with that kind of bias, which should be avoided by doing a reality check. Then status quo bias, where like people remain in their particular status, they don't buy or sell. If they sell something and there is a further profit that could have been done, they will regret. Or if they sell today and their thoughts are not exactly as the markets are not exactly as per their thoughts, they may feel that there is a regret. So to avoid that, they generally remain doing nothing. Then there is a bias called hindsight bias, where like they always recall some good winners and they feel proud of themselves that I have invested in that particular stock and that particular stock has given me good returns, whereas they forget that during the same period they have invested in some other stock which have not given the good returns. Hence, people should avoid this kind of hindsight bias. Recency biases, these are generally giving too much weightage on the recent information or recent news, like some companies got some orders or somebody has joined some company, and that's how they base their investment decision without doing a proper check on the fundamentals or the other technical part of that particular company. The other bias is called attention bias, where like media give lot of focus to some of the stocks or securities, and if we have some money, we go and search on the internet or newspaper or magazines and we get some name prominently displayed because they are grabbing our attention. We think it's good and we generally go with that, which may not be the most optimal I will say the investment. Hence, people should avoid this kind of attention bias by doing a proper research and proper studies. If we go to the cognitive side of the errors, there are a lot of errors people do on the cognitive, which are like mental accounting, anchoring, framing, and decision paralysis. So in mental accounting, what happens is people generally treat a very similar sum of money generated from one source as different from the very similar sum of money generated from other source. Like they will be very cautious on spending their salary income, where they will be extravagantly spending the bonuses or say income tax refund or some kind of lottery. So they just think that this bucket of money is for spending, this bucket of money is hard-earned money, so we should treat them differently. This is just a mindset issue. Similarly, there are anchoring bias or endowment bias. People generally value their ownership and they try to do a loss aversion. They generally think that whatever stock, suppose they have inherited, those are very close to their heart, and what they inherited is a very prized possession, and they generally don't want to sell it out. Hence, they keep on hanging on to those stock and lose on to the many good opportunities which are available. Then there is a framing error in which people generally lack the proper information processing, and this kind of biases, they generally go with a wrong decision. What happens, like in a particular case, a particular information is passed on to a particular person and they get influenced how the information is presented. If 10 good things are there and 100 bad things are there, they generally focus on those 10 good things because they think that is what it has been presented and has more weight. And the last one is decision paralysis or choice paralysis or analysis paralysis, where like people generally lack decision making because there are too much of options available and they are not able to evaluate, or they will invest in a suboptimal manner by investing in so many areas. How do we eliminate these biases? Are bubbles, and first we will cover the bubbles and crashes. Bubbles means when a particular sharp rise in asset price happens, because a general expectation is that people will keep on investing, and there is a structural change in the productivity, like say engineering boom or electricity boom or a technological boom, or there is a justifiable logic that assets are giving a lot of productivity. That's how people perceive those information, and a lot of people invest, and then bubbles are created. Many times bubbles are created not just for genuine reason, but also for other reasons like liquidity, celebrity, momentum, or illusion of control. So liquidity happens when too much of liquidity is there in the system and all the money keep flowing towards the particular stock or particular sector. That particular stock or sector get bubbled, and cheaper borrowing also fuels those investments. Celebrity status, sometimes media give a celebrity status to particular company, their product or their management team, and that's how people get swayed and they keep on investing in them. Momentum is a particular set of people, they read the particular news in a positive or negative manner, and accordingly momentum is set. When a lot of people keep reading those news in a positive manner, they all try to acquire that stock, invest in that stock, and an uptrend momentum start. And that's how this momentum creates bubbles. Similarly, illusion of control is when familiarity, access to the information happens. When people think that, oh, I know that particular company, their people, their product, or somebody is working there, some insider information I will get. So they generally are under an illusion of control that they are superior enough and able to take a faster decision than others and make a lot of money. That's how they generally invest, and that's when many people invest in such manner, a bubble is created. What happens to crashes? This is exactly opposite to the bubbles. Like when all the information is taken in a negative manner, there is a liquidity crunch, or some defaming has happened to a particular product or a company, and that's how these crashes come. How to eliminate the biases? Of course, we should recognize that we are human beings, and when decisions are made, we are generally swayed away by those particular biases, and hence we should be very mindful of our biases. We should understand whether our decisions are done objectively, that is proper factual data is analyzed, research is done, and we are not just impacted by emotional responses. For biases, we should first avoid the mistakes, typical biases is done by setting the following rules. Like we should have our investment policy, which is dependent on investment objectives. So the philosophy and objective should be set. Risk evaluation, whether we can take high, moderate, or low risk, that analysis should be done. We should create appropriate investment policy and understand our constraints on the investments or risk side, and accordingly we should invest. We should follow the strategy of asset allocation, diversification, a long-term investment horizon. We should do proper research and analysis, do evaluation of the stocks, follow the fundamentals. We should properly review and rebalance whether our equity or debt or the mid cap, large cap, small cap, all those different angles are properly filled, and accordingly take decision. We should not attempt to take shortcuts by just investing through emotions or borrowing money to make larger gains, which may be counterproductive and very risky. And if required, take the help of investment advisors. They are there to help you out. And with this, I finish. I would suggest, friends, this is your hard-earned income and a lot of sacrifice you have done to save them. So please invest them carefully. Be mindful of your biases before you invest. And if you have liked this particular video, please like it, subscribe it, share it with your friends and families, and of course click the bell button to get similar useful videos in future.